Understanding multilateral trading facilities, MTFs. A multilateral trading facility, MTF, is a crucial component of the European trading landscape, serving as an alternative trading platform where multiple parties can exchange financial instruments. This article will delve into the characteristics, advantages, and implications of MTFs, helping readers understand their significance in modern finance. What is an MTF? An MTF is essentially a trading system designed to facilitate the exchange of various financial instruments among eligible contract participants. These trading venues are important in enabling the trading of securities that might not necessarily have an official market. Most MTFs are electronic systems managed by authorized market operators or large investment banks, offering an efficient and streamlined trading experience. Traders typically place orders electronically, which are then matched by sophisticated software engines that pair buyers with sellers, optimizing the trading process. Key takeaways. Alternate trading platform, MTFs provide retail investors access to a broader range of financial securities. Operator control, they are often operated by market operators or higher-tier investment banks. Regulatory framework, MTFs are governed by the EU's MiFID II, Markets in Financial Instruments Directive II, aimed at increasing transparency and investor protection within financial markets. Diverse offerings, MTFs frequently offer more exotic trading instruments and over-the-counter, OTC, products than traditional exchanges. U.S. counterpart, in the United States, MTFs are referred to as alternative trading systems, ATS. The role of MTFs in financial markets. Before the establishment of MTFs, trading for investors was typically confined to national securities exchanges like the London Stock Exchange, LSE. MTFs disrupted this traditional model by providing a wider platform for trading, which includes less common financial instruments. For instance, venues such as the LMAX exchange have successfully facilitated trading in spot foreign exchange and precious metals. Notably, MTFs have become popular due to their operational efficiencies, including faster transaction speeds, reduced costs, and various trading incentives, particularly in Europe. However, the rise of MTFs has also led to a fragmented trading environment where securities are listed across multiple platforms, prompting brokers to implement smart order routing strategies to ensure the best pricing. MTFs operate under a stringent EU regulatory framework designed to provide greater transparency and security to investors. MiFID II aims to enhance investor confidence and enforce stricter guidelines on operational practices, including how trades must be executed. MTFs in the United States. In the United States, the regulations governing MTFs are similar to those of alternative trading systems, ATSs. Although ATSs often operate as broker-dealers rather than conventional exchanges, they must still gain approval from the Securities and Exchange Commission, SEC, and adhere to specific compliance regulations. The SEC has increased its focus on enforcing rules surrounding ATSs and may lead to stricter regulations for MTFs in Europe as well. Among the well-known ATSs in the US are electronic communication networks, ECNs, which function to automatically match orders in the market. Advantages of MTFs. The emergence of MTFs has several inherent advantages. 1. Transparency. MTF operators are obligated to execute trades based on predefined rules without any preferential treatment. This accountability creates a transparent trading environment. 2. Increased liquidity. The rapid matching of buy and sell orders, often facilitated by high-speed trading, enhances liquidity compared to OTC transactions. 3. Reduced costs. MTFs typically operate on a commission basis, which eliminates the potential conflicts of interest often encountered with individual traders. 4. Access to exotic instruments. Investors can explore a wider variety of financial products and instruments, promoting a more diverse investment strategy. Real-world examples of MTFs. Investment banks and data companies are increasingly exploiting economies of scale through MTFs. For instance, UBS Group established an MTF that works closely with its internal systems dedicated to order matching. Notably, in 2019, Bloomberg received authorization from the Netherlands Authority for the Financial Markets, AFM, to operate its MTF in Amsterdam, which provides trading capabilities in a variety of financial instruments such as cash bonds, repos, credit default swaps, CDS, interest rate securities, ETFs, equity derivatives, and forex derivatives. Distinguishing MTFs from OTFs. It's essential to distinguish between MTFs and organized trading facilities, OTFs. OTFs are unique venues intended for trading bonds, derivatives, and emissions allowances, excluding equities. Unlike MTFs, the operators of OTFs possess a degree of discretion over order placement and withdrawal, leading to different operational protocols. Major players in the MTF landscape. The largest MTF operating in Europe is Chi-X Europe, known for its regulatory compliance across the European Economic Area. Other significant players include Liquidnet Europe, Currenex MTF, and UBS MTF. Conclusion. Multilateral trading facilities have revolutionized how financial markets operate, offering greater access, transparency, and liquidity to investors. They are becoming increasingly integral in the landscape of trading, particularly in Europe, while also shaping regulatory practices worldwide. Understanding the dynamics of MTFs can provide investors with valuable insights into modern trading mechanisms, hence enhancing their investment strategies in a complex financial ecosystem. Investopedia does not provide tax, investment, or financial services or advice. The information is presented without consideration of the investment objectives, risk tolerance, or financial circumstances of any specific investor and might not be suitable for all investors. Investing involves risk, including the possible loss of principal.